I feel like I lost the opportunity of interacting with Professor Sargent in the past. I wasn't that lucky like Jesus or Albert. But in a way, I feel lately kind of closer to him because we hired a very good student of Tom Sargent coming out of the NYU last year. So I'm learning a lot from a student of Tom Sargent about how Tom Sargent is thinking about economics. So I guess this is not the ideal world, but at least it's working for me. So we've been here many good things in this presentation. So so Professor Sargent started being apologetic about not using equations. So I think I need to apologize because I'm going to use some equations in my presentations. I want to start by saying something that Rafa was mentioning too, is about that economics is not about forecasting, it's about understanding. So I found a good example of that by one of my, of course, favorite economists, one of the greatest scholars in understanding business cycle, how the economy moves around a trend. And it was Robert Lucas. In 2003, he wrote a very interesting article at the American Economic Review called Macroeconomic Priorities. And this slide tried to illustrate why he was saying what he was saying there, and why it's very important to think about what he was saying as what I think is an initial condition. Again, I'm bringing an initial condition here as an extra degree of freedom. It's hard to, as Professor Sargent was saying, to think about what's time zero. Well, time zero for me, for my presentation, will be Lucas 2003. So he was saying macroeconomy was born as a distinct field in the 40s, as an intellectual response to the Great Depression. That's a great quote. So the Great Depression forced people to think hard about business cycle. I'm going to get back to the Great Depression later. But at the same time, he was saying, in this lecture, what he was writing at that time is that macroeconomy, in this sense of learning how the economy fluctuates, has succeeded. It's the central problem of depression and prevention has been solved for all practical purposes and has, in fact, been solved for many decades. And that was reading in 2003. So he wrote that by thinking in these two. That's a simplification that central banks usually do. It's probably wrong, but it's going to be helpful for what I'm going to say later. So we have the volatility, the change in the GDP in the United States in this panel. And this is inflation and inflation expectations, different sample periods for the reason I'm going to say now. So it's starting in the 50s. So you see that when Professor Lucas was saying what he was saying, so this is what was called the Great Moderation. So the volatility of the output in the United States dropped dramatically for what the volatility was in the past decades. And at the same time, inflation was coming down dramatically, and inflation expectations were kind of relatively stable, especially in the first half of the last decade. So it was making a lot of sense what he was saying at that time. So what happened is that, well, in the background, there was, as Albert was describing, there was this housing bubble in the United States, like in other countries. So here's a plot of what happened. This is the evolution of personal income in the United States, which is the real, the red line. And the blue line is what's happened with the house prices in the United States. As you see, in 2007, starting a little bit before in 2006, there was a huge collapse in the evolution of the housing price. This is a result of some sort of a coordination in the expectation, such a way that people start believing that there's some profits related to getting into that market. Of course, that creates something that's like a banking crisis. That here, I'm going to go back to the Great Depression. This figure is what's happened with the banking sector. There was a collapse of financial intermediation, and the way you think about collapsing the financial intermediation is that think about what happened in 29 and in the 30s in the U.S. So, and this brings me to another great quotation from Professor Sargent's presentation, paraphrasing Stigler. Is that crises are bringing new issues or not. This is pretty similar if you read history. Or if you read books of the 30s, you read the history of what's happened in the 30s in the United States, has a lot of similarities to what's been going on in the United States and other countries right now. So here you see in this figure the banking failure in the United States, and you see a huge amount of bank failures associated with the Great Depression. And this is the banking failures that happen now. So the mountain is kind of not very big relative to what was going on. But if you look at in terms of total asset and total deposits of this banking failure now, as what was happening in the Great Depression, so the size of this, what the economists call shock, of the size of what was going on in the economy now after this big recession, it was clearly a few orders of magnitude to what was going on in the Great Depression. That's very important for thinking about policies down the road and for thinking about how do we need to think about models and policies. So of course, because of this banking crisis, financial condition tight, and lending conditions, of course. So there's another plot that probably many of you have been seeing lately. So this is just a survey that is conducted at the Federal Reserve Board, and it shows you what's happening with the demand and the supply of credit in the United States. So you see that during this Great Recession period, there's a fall in the demand for credit, and at the same time, financial institutions were tightening because the standard for getting a loan were a lot higher than in the past. And what's happened with corporate spread or with credit or with borrowing in the economy, they went to the roof. So when a firm tried to even bypass financial institution and try to use capital markets to issue debt, the conditions were a lot tighter than before. And those are, by all means, incredibly high spreads, so the amount of risk in the economy increased dramatically. And this is some of the theme that Professor Sargent has been trying to study and try to understand in many papers. So what's happened as a result is there is a collapse in activity in the US, but given the size of the shock that we've seen in the last few years in the United States, you see here the evolution of the GDP growth in the United States back to the 19th century. And you see the Great Depression in which output was falling almost 30%. Of course, something happened after that, as you see the huge rebound. And so that's give you a fantastic laboratory to think about policies and to think about how agents form expectation. And you see that now, given the size of the shock, GDP was not that dramatic fall, but it was, after the World War II, a significant drop in activity, closer to 10%. That's, as Jesus was describing, translating into unemployment. And what's happening with prices? And that's going to be useful for thinking about policies. Well, but prices, you see, this is normalizing at the peak of the expansion. And the blue line is what's happening with prices after the Great Depression. You see prices falling. It means deflation. So price fall in 3 years, 25%. So something that was 100% value in 29, in 33 was only 35% of that value. And what's happened in the current situation, which is the yellow line? Well, prices move, but by all means, there was not such a deflationary problem. So that tells you something about policies, about how important it is to think about these facts, and in thinking about policies implemented in the United States and what kind of models are useful to explain why, given the shock in financial intermediation, didn't translate into activity and inflation in the way we saw in the 30s. Okay, of course, coming from a central bank, I need to talk about policy instruments, and here's something that you probably have seen many times. So this panel shows the interest rate. Of course, after this is the interest rate starting in '88. So you see that because of this dramatic fall in activity and the worries about prices falling, the central bank would like to move the interest rate, which is the basic instrument that we use to affect prices and output in the economy. We'd like to have the interest rate, the nominal interest rate, below zero. Of course, that's really hard. It's possible, but it requires some institutional arrangement that probably not very easy to implement. So what do we do when we would like to have negative interest rate and you can't? So this introduces a very interesting, what we call nonlinearity in our way of thinking about monetary policy. And at the same time, we were not paying attention to the demand for deposit of financial institutions that have in the central bank. So here in this plot, we have the evolution of the excess reserve, so the amount of reserve that financial institutions are now holding at the central bank, at the Fed. And the red line is inflation. So you see that during the recession, this dash area here, so inflation was trying to see some symptom of deflation, and at the same time we rise the balance sheet of the Fed by more than $1 trillion. And immediately you see a rebound in inflation. So that tells you something about how to think in terms of policies. It's not easy, but that tells you something about what we have learned about some of the mistakes that were made in the 30s. Okay, so with all this background, what I'm trying to spend some time is coming back to Lucas. Probably 2007 and 2009 introduced new challenges in trying to integrate business cycle, asset pricing, and financial intermediation. I think that's something that's going to be with us, and has been with us for a long time. So this is something that probably economists forgot, but now this crisis is bringing back to our way of thinking about how to model that. So Rafa asked me to think about why this is important and how people that work at the Federal Reserve, especially in the group that I attached to, that basically try to think in terms of models, try to deal with all these complicated problems. So I'm going to try to talk a little bit about how do you think about financial frictions as a way of thinking about the persisting and the amplification of fluctuations in the economy, how that's there are different ways of thinking about that. So there's so many shortcuts that have been taken in the literature. So thinking about this is just something that happened, and it's something that I don't know, I don't understand. It's kind of the shocks of exogenous approach is completely out of the model. Or thinking about, well, there's something in my model that needs to be building. Thinking endogenous propagation of this kind of collapsing financial intermediation and how these translate into activity and prices. But I'm going to spend most of my time thinking about challenges of monetary policy, and not just that we need something new. It's just how to use the tools that we have to understand the challenges in terms of this nonlinearity introduced by the zero lower bound, that the willingness of the central bank to affect the economy even if the nominal interest rate is stuck at zero. And there's many contributions in that literature. That new model that we have, bringing some sort of new interesting way of making commitment by a central bank that are not attached to the usual way of thinking about commitment, coming from the Barrow Gordon, but trying to, this is Woodford, is professor at Columbia now, that try to exploit future expectation to improve outcomes today. Okay, so I'm not going to make it. I have a lot of stuff here to do in 10 minutes. So, and then I want to try to talk a little bit about how important is the size and the composition of the balance sheet. This is coming back to this beautiful paper by Neil Wallace. This is the idea of how relevant is the composition of the assets of the balance sheet of the Fed in affecting relative price of assets in the economy, and so output and prices. And of course, this opened a bunch of interesting issues that are related with how do you think in terms of these big shocks, and usually the tools that we use to understand policy and to understand business cycle are looking at the small fluctuations of the output and prices around medium and long run path, and how these change our way of thinking about solving models beyond these simple linear approximations. So those are some of the issues that we all have been working in the last years and are very relevant for policy now. Okay, so I have some basic three equations here. One is about asset pricing and how you think in terms of assets in the economy, and how you think in terms of output and interest rates. So the basic valuation equation that is probably one of the most beautiful equations you can think of. It just tells you that the price of any assets is just a payoff X that is discounted. That is discounted by something that we call here M. Is what Professor Sargent was saying, is a stochastic discount factor. And that makes a huge difference between economies and accountants or even actuarial. So the discount factor is try to capture this idea of that you discount subject to risk in the economy. And the way you think about this risk is by thinking about how do you change consumption between today and tomorrow. And this is what you have here. So this simple equation that tells you how you value asset is one of the key equations that people like Mike Woodford use to think about once you have you take into account the aggregate resource constraint in the economy to link in output, which is what I call here YT, and expected future real interest rate, which is what I call here R and pi t plus 1. So what this equation is telling you is that thinking about output today is just thinking about what's going to happen with interest rate, not with short-term interest rate today, but what the expected future value of inflation and interest rate is going to be set. So the central bank has some power to manipulate expected inflation or not, or have some power to manipulate expected future short rate. If this is the case, then this simple model will tell you something about what's happening with outcome today, what's happening with output today. So that's imposed some interesting dynamic constraint in the economy. Of course, underlying there's an equilibrium real rate that depends on something that you hear a lot in the news too. So the real rate without any kind of friction in the economy can be attached to growth or to uncertainty, to the volatility of the output in the economy. So if growth is low, the real rate is going to go down. Or if people are really taking action as a way of insurance against bad situation, so because of the risk of the volatility of the economy is really high, then the real rate is going to go down too. So a situation in which growth is low, uncertainty is high, push the real rate down, the interest rate that the ECB, the Fed try to approximate is going negative, and there are different ways of getting to that, but are going to be affected by the fact that the nominal interest rate cannot go below zero, even if the real rate can. Yeah. Okay, so there's risk. I don't have time to explain that. I don't have time to explain that. I'm not going to get into this. I'm going to get into that because there's another interesting piece here. So that's the piece of output. This is the piece of inflation. So a way of thinking about inflation, about pricing the economy, is to say firms set price looking at future marginal cost. And that tells you that inflation today depends not just on today's output. It depends on today's output given expected inflation. And that's very important because it tells you that if you want to change inflation today, you really want to affect not just output today, but output in the future. So you get this interesting loop of expectation, future decision of the central bank about interest rate matter for output today and output tomorrow matter for inflation today. And this is the kind of model that you can use to think about some of the limits imposed to the evolution of the nominal interest rate in an economy. A simple way of describing this model is by using something that closes it. So we have two equations, one for output and one for inflation. And the third equation is going to be used to say something about how the central bank set the nominal interest rate. Usually, it's just a relationship between the outcomes, inflation and output, and the value of the rate. But the zero lower bound imposes a limit here. So it becomes a nonlinear function in the context of the current situation in the United States and in Europe too. I have some stuff here that so this is just to give you an example of how do we think in those terms? So this graph plots something that we do at the Fed. So it tells you different path for the nominal interest rate and different path for unemployment and for inflation. Thinking in the terms that I described, this very simple toy model that has a lot of expectation built in. So there are 3 lines here, the red and the blue and the green. And those lines are lines that are linked to different way of setting interest rate. So the red line is a way of thinking about setting interest rate without paying much attention to what's happened to unemployment. I'm thinking more about what's happened to inflation. So if you look at that sort of rule, that tells you that you want to start increasing interest rate very soon, very, very soon. And the result is that unemployment is going to stay high for relatively long time. And inflation, of course, is going to be subdued for a little while too. So if you start promising keeping the interest rate low for longer, like what we call here a balanced approach. A balanced approach is that you're thinking more about the dual mandate that the Federal Reserve has, and it's to think about the situation in terms of the labor market. So you start thinking better outcome because you're making promises that translate into a lower unemployment and a little bit higher inflation. But that's still not the optimal policy, which you think about in terms of the model that I described. So you can even make even further promises, keeping the interest rate even lower for longer, and that's going to improve your outcomes. It's going to improve your outcome because it's going to make unemployment getting closer to the initial employment level before the crisis, and as a result, you're going to increase inflation for a long time above something that is close to 2%, which is what people tend to believe is a good approximation for price stability in the economy. This is just an example of how the tools that Professor Sargent and Albert and Jesus were describing before in thinking about how you can think of monetary policy. So just to finish, of course, it's open many issues, but I want to just finish with this remark. So there's a wonderful interview that Professor Sargent gave to the region in Minneapolis. And in that interview that I recommended to everyone, he said, in our dynamic and uncertain world, our belief about what other people and institutions will do play big roles in shaping our behavior. So try to incorporate these into these simple models. It will be part of our research in many departments, not at the Fed, in the next few years. So I'm glad that I can read this kind of sentence because are pretty motivating for what we're doing at the Fed. Thank you.